Welcome back to the deep dive. So, we got a ton of source material from you about a really stressful trading day a lot of people just went through.
We did. We're talking about Tuesday, November 18th, 2025. It was fascinating and, frankly, pretty painful to watch in real time.
Yeah, and the market closed, what was it, markedly lower for the fourth straight day.
That's right. It was a really rare bout of turbulence, especially when you think about how good the year has been otherwise.
Exactly. So, our mission today is to get into that fear, the whole AI bubble conversation that just seemed to explode.
And to really understand the core tension, which is what hammered the stocks that day,
This huge, almost unprecedented amount of spending that's happening right now.
versus a financial payoff that feels, to a lot of people, very uncertain and maybe very far down the road.
This isn't just market noise. We have to start with the specifics, the actual damage report from that Tuesday.
Okay, so let's get into it.
So the Dow Jones Industrial Average, that's always one people look at first, it dropped 498 points.
Which is a clean 1% fall for the day. A big number.
But the real story was in tech, wasn't it?
Always is when you see moves like this.
Mm-hmm.
The S&P 500 fell 0.8%, but the Nasdaq, the one that's full of tech stocks, it just tumbled. It was down 1.2%.
And when the Nasdaq is leading the charge downhill, you know exactly where the anxiety is.
It's focused on those high-growth, high-valuation companies. And the fear was really specific this time. It was all about AI.
Right, the sources pointed to this concern about an AI infrastructure bubble. And it's not some, vague feeling. It seems rooted in the sheer amount of money these companies are spending.
It is. The scale of the capital expenditure, or CapEx, is just staggering. We're talking about big tech committing to spend literally hundreds of billions of dollars.
Hundreds of billions on what exactly? Is it just buying more computers, more servers?
Oh, it's so much more than that. I mean, they're building these massive energy-guzzling data centers from the ground up.
Designed specifically for AI, specifically for training and running these huge language models. They're buying specialized chips from companies like Nvidia or designing their own, which is incredibly expensive. And then you have to power them and keep them cool.
So it's this foundational mandatory spending if they even want to compete.
You have to do it. And that sell-off, it hit some of the biggest companies in the world. It really highlights this fundamental disconnect we've been talking about.
The disconnect between the spending now and the profits later.
Exactly. You've got this massive CapEx bill today versus AI service revenue that's still, just getting started. It's the core dilemma, and it's what's making the market so skeptical.
This is really the heart of it, isn't it? It's like we're in the most expensive research and development phase in the history of technology.
I think that's a perfect way to put it. And we found some incredible analysis on this from Callie Cox. She's the chief market strategist over at Ritholtz Wealth Management.
Right. Her commentary really nailed the whole thing. She did. Her quote is basically the anchor for this whole deep dive. She said, "Tech companies have to spend to keep up with surging demand, but that demand largely hasn't turned into profits or productivity."
That last part is key. Profits or productivity.
Yes. So they have to be in this AI arms race to stay relevant, but the actual efficiency gains, the actual money coming in, it just hasn't caught up to the cost.
And so investors get nervous.
Of course, as she put it, investors get skeptical about the payoff. And that skepticism is exactly what drove this wave of selling.
Can you maybe give us an analogy here? Like, what does spending hundreds of billions on something with an uncertain payoff actually look like for a company?
Okay, sure. Imagine you decide you need to build the world's most advanced factory, a multi-billion-dollar factory.
Okay.
You're building it because you just know that one day the product it makes, let's say it's the perfect digital assistant, will be in huge demand. But the factory itself costs a fortune to run. And it's hundreds of billions of dollars before you've even sold a single unit.
And then your competitor builds a factory right next door.
Exactly. And you both have to sell the product cheap to compete. So investors are looking at this huge immediate bill, the CapEx, and a future income that looks less and less certain. So the market is just saying, okay, we have to discount that future payoff.
That makes perfect sense. And that anxiety points directly at the companies that led this whole rally in the first place.
It does. It points right at the Magnificent Seven.
The cohort we've all been watching. So that's Alphabet.
Alphabet, Amazon, Apple, Meta, Microsoft, Tesla, and Nvidia.
All of them. They basically drove the entire market's gains for most of the year.
And these worries about AI spending have thrown a lot of cold water on them recently.
We're seeing it in the numbers, too. Your notes here show Nvidia, they're the poster child for the AI boom. Their shares dropped nearly 9% since late October.
Right. And it's worth digging into why Nvidia and say, Meta are such good barometers here.
Okay.
Nvidia sells the pickaxes in this gold rush, right? Their whole valuation is built on this idea of never-ending explosive demand for their chips.
So if their biggest customers start to slow down their spending.
Then Nvidia's massive valuation starts to look a little shaky. That 9% drop is pure repricing risk. Investors are getting nervous.
And Meta is one of those huge customers. They're spending a fortune.
An astronomical amount. And they've seen their stock decline, what, 17% over the past month?
Wow, 17%.
Yeah. And that is tied directly to their spending. The market is looking at their quarterly reports and asking, where's the profit from all this spending? The build it and they will come philosophy is wearing thin.
And this isn't just a one-day problem, is it? It's part of a bigger trend. The week before, the Nasdaq fell 3%.
Which was its biggest weekly drop since that whole Liberation Day tariff situation with President Trump back in April.
That's a really significant comparison. That was a huge geopolitical shock.
It was a massive external shock. The fact that an internal worry, just a concern about spending versus cash flow, can cause a drop of similar size.
It shows you how nervous the market really is.
It shows the market is demanding proof now, not just promises.
Okay, so we've covered the damage and the reasons for the skepticism, but we need to give some perspective here. Is this the beginning of the end, or is it just a correction?
That's the crucial question. And all the sources suggest it's the latter. This feels like a correction inside a very strong upward trend for the year.
So investors aren't just abandoning tech completely.
No, not at all. They're just adjusting their expectations. And you can see it in the year-to-date numbers, even after all this selling.
The market's still up for the year.
Very much so. The S&P 500 is still up 13% in 2025. The Dow is up a respectable 8%.
And the Nasdaq.
The Nasdaq, even with its recent tumble, has still soared 17% this year. So this is a pause, a repricing. It's not a complete reversal of the year's momentum.
That's such an important piece of context. So the underlying story of tech growth is still there.
It is. And that brings us back to that long-term outlook from analysts like Callie Cox. She still believes AI will likely pay off in economic benefits down the road.
It's just a question of when down the road is.
Exactly. This sell-off is a digestion period. The market is moving from pricing in the promise to trying to price in a realistic timeline for delivery.
So what does this mean for you if you're listening and your portfolio is full of these stocks and you're feeling, well, pretty overexposed right now?
The advice we're seeing is pretty clear. If you're heavily concentrated in those magnificent 7 stocks, the consensus is simple. You have to ride out this phase of selling.
So don't panic sell.
Right. This volatility is basically the price of admission if you want to be part of the long-term AI revolution. If you believe in that future, you have to be able to stomach the short-term uncertainty.
It really all boils down to that tension then. Companies absolutely must spend these billions now to stay in the game.
But investors are demanding to know when that spending will turn into actual, reliable profit.
The AI bubble fears are just the market putting a price on that uncertainty.
Precisely. The market is saying, we believe in the tech, but we need a clearer timeline. The enthusiasm is still there. It's just the short-term risk just got a lot more expensive.
Which leaves us with a provocative thought for you to think about this week. The sources all highlighted that AI demand is surging, which is causing all this spending, but the profits haven't followed yet.
A huge difference between those two things.
So what stands out to you about the gap between massive demand and actual profitable productivity? And what do you think investors will focus on more in the next phase? Will they keep cheering for demand, or will they only accept real bottom-line profits from here on out?
That question of efficiency. It's going to define the rest of this year and probably all of next year. Definitely something to keep in mind as you watch the markets.
We'll catch you on the next deep dive.